The unthinkable has happened. London's silver vaults, the backbone of global precious metals trading for over a century, are running on fumes. And as of today, December 23rd, 2025, silver has shattered every record in the book, breaking through $70 per ounce and briefly touching $71.09 in early trading. This isn't just a price spike. This is a structural break in the system. Let me paint you a picture of what's really happening behind the headlines. The numbers don't lie. The London Bullion Market Association vaults, which serve as the epicenter of over-the-counter precious metals trading worldwide, have seen their freely available silver stockpiles collapse. We're talking about a drop from over 300 million ounces just a few years ago, down to approximately 125 to 135 million ounces of free-floating metal available today. Think about that for a second. The daily trading volume in the silver market averages around 250 million ounces. That means there's less than 1 day's worth of actual physical silver available to back the paper promises flying around the market. It's like running a bank with barely enough cash in the vault to cover a single day's withdrawals. Daniel Gali, the commodity strategist at TD Securities, who's been tracking this developing crisis, put it bluntly. There are probably less than 4 months remaining until the LBMA's entire free-floating stockpile could be completely depleted. 4 months. That's not a comfortable buffer. That's a ticking time bomb. How did we get here? This didn't happen overnight. Silver has been operating in a structural deficit for 5 consecutive years. Industrial demand has been outstripping mining supply year after year. In 2024 alone, the market deficit hit nearly 149 million ounces. Over the past 4 years, the cumulative shortfall has reached 678 million ounces, the equivalent of 10 months of global mining supply. But the real pressure cooker moment arrived in October 2025. 3 things happened almost simultaneously that created what traders are calling the perfect storm. First, India, one of the world's largest silver markets, went on an unprecedented buying spree. Imports doubled in September compared to the previous month, driven by the Diwali festival season. Indian buyers weren't just buying coins and jewelry, they were absorbing industrial-grade bars by the millions of ounces. When Hong Kong couldn't supply enough metal, India pivoted to London, and London's vaults, already stressed, started hemorrhaging silver. Second, China's Golden Week holiday in early October created another surge of demand from the East, piling onto the pressure from India. Third, and perhaps most significantly, exchange-traded fund inflows exploded. Investors worldwide, watching inflation concerns mount and interest rates beginning to ease, poured money into silver-backed ETFs at a pace not seen in years. The problem? Those ETFs need actual physical silver to back their shares, and they pull that metal from the same London vaults everyone else relies on. The Great Vault Exodus. Here's where things get wild. In just 30 days during October, 29 million ounces of physical silver vanished from COMEX vaults in the United States. That metal wasn't disappearing into thin air. It was being shipped across the Atlantic to replenish London's critically depleted stockpiles. The arbitrage had flipped. For the first time in years, silver prices in London were trading at a $3 premium over New York futures. That's an enormous spread in the precious metals world. It's like watching water flow uphill. It only happens when something fundamental is broken. Lease rates, the cost to borrow physical silver, went absolutely parabolic. We're talking rates that spiked to 35% in October on an annualized basis. Some overnight borrowing costs exceeded 100%. Those aren't normal market conditions. Those are panic conditions. That's the sound of bullion banks scrambling desperately to find actual bars to deliver against paper contracts they've already sold. The India story. You need to understand. Let's zoom in on India for a moment, because this is crucial to understanding where we're headed. Phil Baker, a veteran silver market analyst, recently described India as the marginal buyer, driving prices above $45 to $50 per ounce. Indian demand hasn't just grown, it's quadrupled. And here's what's fascinating. Indian buyers are still buying even as the rupee price of silver hits record after record. Think about that psychology. When local currency prices are screaming higher and people keep buying anyway, that tells you something about their expectations for the future. They're not speculating, they're protecting themselves. When JP Morgan Chase, the world's largest precious metals trader, tells major Indian clients in October that they have zero silver available to ship, you know the situation is serious. Several Indian ETFs had to stop accepting new orders because they simply couldn't source the metal. Yet other funds kept accepting money, raising serious questions about whether they could actually acquire the silver they needed. The paper versus physical disconnect. Here's the uncomfortable truth that's now impossible to ignore. The silver market has been operating for decades on the assumption that paper contracts and physical metal are essentially the same thing. As long as confidence held, it didn't matter that daily trading volume was dozens of times larger than available physical inventory. But confidence is fragile, and right now it's cracking. Much of the silver sitting in London vaults is already spoken for, allocated to ETFs, pension funds, and institutional investors. That metal is effectively off the market unless those holders decide to sell. The real liquidity crisis is in the unallocated pool, the free-floating silver available for immediate delivery. Estimates suggest that as of late November 2025, there might be only around 200 million ounces of silver truly available to buy or borrow in London. That sounds like a lot until you remember the market trades 250 million ounces per day on paper. The industrial demand time bomb. We haven't even talked about the elephant in the room. Industrial demand is accelerating, not slowing down. Silver isn't just a monetary metal anymore. It's the indispensable metal of the digital age. Solar panel installations are exploding worldwide as countries race toward renewable energy targets. Every solar panel requires silver for its photovoltaic cells. Electric vehicle production is ramping up, and EVs use significantly more silver than traditional cars. Data centers powering artificial intelligence are proliferating at breakneck speed, each one demanding silver for circuit boards and electrical connections. The AI energy complex alone represents a massive new source of demand that barely existed 5 years ago. Companies are stockpiling 6 to 9 months of silver inventory because they can't risk production shutdowns. And here's the kicker. Recycling can't keep pace. You can't thrift your way out of this shortage in the next 12 to 18 months. Today's breaking records. As of this morning, December 23rd, 2025, silver is trading around $70.90 per ounce. Earlier in the day, it briefly touched $71.09, a fresh all-time high. The intraday range has been volatile, swinging between $68.84 to over $71 as traders grapple with thin year-end liquidity. For context, silver is now up 141% year-to-date. Read that again, 141%. This isn't a 20 or 30% move. This is a fundamental repricing of the metal. Gold, by comparison, is also hitting records near $4,450 per ounce, but silver's percentage gains have been far more dramatic. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has compressed from over 80 at the start of the year to around 64.5 today. Many analysts believe this ratio could fall toward 50 to 60 in the coming year, implying even more upside for silver relative to gold. What's driving today's move? Several factors are converging right now to push silver higher. The Federal Reserve just completed 3 consecutive interest rate cuts this year, and traders are betting on 2 more cuts in 2026. Lower interest rates make non-yielding assets like precious metals more attractive because the opportunity cost of holding them decreases. The US dollar has softened in recent weeks, which mechanically makes dollar-denominated commodities like silver cheaper for international buyers, increasing demand. Geopolitical tensions are running hot, escalating US sanctions on Venezuela. Ongoing trade policy uncertainty and broader concerns about economic stability are driving safe haven flows into precious metals. But underneath all the macro factors and geopolitical headlines, the core story remains. The physical market is tight, inventories are low, and demand shows no signs of abating. The London relief rally. That wasn't. In November 2025, there was a brief moment when it looked like the crisis might ease. London vaults received an influx of nearly 54 million troy ounces of silver in October, the largest single-month increase in at least 9 years. That metal was pulled from COMEX warehouses in New York, from Shanghai Futures Exchange inventories, and even from ETF liquidations. Some analysts called it a pressure release valve. TD Securities suggested the silver squeeze might be approaching its end game. For a few weeks, London spot prices normalized relative to New York futures and lease rates cooled. But here's what those analysts missed. That relief was temporary. The fundamental imbalance didn't change. Industrial buyers are still hoarding. Indian demand hasn't stopped. ETF inflows continue. Mine supply remains capped. The vaults may have gotten a temporary reprieve, but the underlying deficit is still there, still growing. By late November, vault holdings showed a modest 3.5% increase to 27,187 tons, valued at $47.1 billion. That sounds better than the October lows, but it's still well below the 300-plus million ounce levels the market operated with comfortably just a few years ago. The system is fragile. What we're witnessing is a stress test of the entire precious metals trading infrastructure. For decades, the system worked because everyone trusted that if they really needed physical delivery, they could get it. That trust allowed massive leverage, hundreds of millions of ounces changing hands daily on paper while only a fraction of that existed in available inventory. But trust is binary. It either holds or it breaks. And once it starts breaking, the rush for the exits can happen fast. Imagine if just 10% of silver futures contract holders decided they wanted physical delivery instead of rolling their contracts forward or settling in cash. The system couldn't handle it. There isn't enough free-floating metal. Prices would gap violently higher as dealers scrambled to source silver from anywhere. vaults in Zurich, Singapore, or even smaller regional depositories. This is what happened on a smaller scale during the Hunt Brothers squeeze in 1980. And it's what's starting to happen now, except this time it's not driven by a few billionaire speculators trying to corner the market. It's being driven by structural deficits, industrial demand that can't be delayed, and a global investment community that's waking up to the supply-demand imbalance. Where do we go from here? The forecasting debate has shifted from can silver rally, to how high can it actually go. Some analysts are eyeing $75 as the next psychological resistance level. Others point to the previous all-time high of $50 set back in 1980, adjusted for inflation, which would put silver well above $100 in today's money. JP Morgan, which had predicted silver would average just $36 in 2025, has already been proven dramatically wrong. HSBC scrambled to raise its 2026 forecast to $44.50, a number that now looks quaint given we're already at $70. The market has fundamentally shifted, and the old models don't work anymore. Analysts who view silver purely as a monetary metal that moves with interest rates are missing half the story. They're not accounting for the fact that you cannot run ChatGPT servers, manufacture solar panels, or build electric vehicle batteries without silver. It's not optional, it's essential. The physical versus paper reckoning. Here's what keeps institutional traders up at night. The paper silver market operates on leverage ratios that would make a hedge fund blush. The actual physical backing behind all those futures contracts, ETF shares, and OTC derivatives is a tiny fraction of the notional exposure. As long as everyone plays along and settles in cash, the system works. But the moment physical demand overwhelms the available supply, you get a squeeze. And this squeeze has the potential to make previous episodes look like dress rehearsals. Silver market veteran David Morgan has been warning about this for years. His analysis shows the London market's free floating inventory dropping from 305 million ounces to 125 million, a 60% decline. That's not a correction. That's a structural collapse in available liquidity. The AI and energy revolution. Let's talk about something most mainstream analysts are still underestimating: the AI-driven demand surge. Artificial intelligence isn't just about software. It requires massive physical infrastructure. Data centers, server farms, cooling systems, electrical grids to power them, all of it needs silver. The solar boom is directly linked to this as well. As countries and corporations commit to carbon-neutral operations, solar installations are accelerating. Each megawatt of solar capacity requires substantial amounts of silver. The solar industry alone now accounts for a significant chunk of annual silver demand that didn't exist 20 years ago. Electric vehicles are another piece of the puzzle. A typical internal combustion engine car uses about 15 to 28 grams of silver. An electric vehicle can use anywhere from 25 to 50 grams or more, depending on the model. As EV production scales from millions of units to tens of millions globally, that demand adds up fast. And unlike financial speculators who might sell if prices rise too much, industrial users can't simply stop buying. They need the metal to keep production lines running. That puts a floor under demand that's far more rigid than investment demand. The critical minerals angle. In a move that hasn't gotten enough attention, the United States government recently added silver to its list of critical minerals. That designation matters. It signals recognition at the highest levels that silver is not just a precious metal. It is strategic to national security and economic competitiveness. When governments start treating a commodity as critical, they change the game. It opens the door for stockpiling, export controls, and strategic reserves. If other nations follow suit, you could see a scramble where countries compete to secure silver supplies, further tightening an already stressed market. What this means for investors. For financially conservative investors watching this unfold, the message is clear. The paper promises that dominate modern finance are being tested. When vaults empty, currencies weaken, and markets rely on IOUs stacked 100 layers deep, physical assets that can't be printed or rehypothecated become invaluable. This isn't about getting rich quick with some speculative trade. It's about wealth preservation in an environment where trust in financial plumbing is eroding. Gold and silver are promises kept, tangible assets you can hold. Many investors are moving away from ETFs and paper contracts toward actual physical coins and bars. The premium on physical silver products has widened significantly over spot prices, reflecting the reality that obtaining real metal is harder than buying a derivative contract. The months ahead. As we head into 2026, several scenarios could play out. In the optimistic case, mine supply picks up, industrial users find ways to use silver more efficiently or substitute other materials, and Indian demand moderates as local prices climb. Inventories stabilize and the market finds a new equilibrium at higher price levels. But that's the rosy scenario, and it requires several things to go right simultaneously. The less optimistic, and perhaps more realistic outlook is that we're still in the early innings of this squeeze. If TD Securities' estimate is correct, and London's free-floating inventory could be exhausted within 4 months, we're looking at potential delivery failures, contract settlements forced into cash rather than metal, and prices gapping higher as the paper-to-physical disconnect becomes undeniable. The CME Group, which operates COMEX, has already seen what some traders called a glitch recently. Prices briefly spiking in ways that suggested severe stress in the delivery mechanism. That wasn't a software error. That was the system blinking. The bigger picture. Step back and look at what's really happening here. For decades, the global financial system has operated on increasing layers of abstraction. Physical gold became paper gold. Paper gold became gold derivatives. Silver followed the same path. As long as trust held, it worked. But we're seeing cracks in that trust across multiple markets simultaneously. The silver vault drain is happening at the same time we're seeing stress in treasury markets, questions about commercial real estate, and debates about the sustainability of sovereign debt levels. These aren't unrelated. They're all symptoms of a system stretched to its limits. Silver's move to $70 isn't just about supply and demand for one metal. It's a signal that investors worldwide are questioning the reliability of paper assets and seeking tangible stores of value. That's a trend that, once started, is very hard to reverse. The final word. It's gone. The comfortable buffer of silver sitting in London vaults that allowed the global trading system to function smoothly for decades, gone. The assumption that paper and physical were interchangeable, shattered. The old price models based purely on monetary policy and interest rates, obsolete. As of December 23rd, 2025, with silver trading at $70.90 per ounce after touching $71 earlier today, we're in uncharted territory. The technicals look sexy, as some traders put it, with momentum building. But this isn't about chart patterns. It's about fundamental scarcity meeting exploding demand. The next shock, when it comes, will hit harder because there's less cushion left. Every additional ounce drained from London vaults makes the system more fragile. Every industrial buyer who starts hoarding 6 to 9 months of inventory instead of 2 to 3 months removes more metal from circulation. Every new ETF investor who wants physical backing puts more pressure on available supply. This saga isn't over. It's just getting started. And for those paying attention, the message is clear. The world is running short of silver, and the next chapter of this story is going to be one for the history books. Stay vigilant, stay informed, and understand that what's happening in London as silver vaults isn't just a commodities story. It is a window into the fragility of the entire financial system.